As I've explained in previous videos, if we've got any chance of securing an ideal future for ourselves, we know we need to be investing in equities. So in this video, I want to explain stock markets and how they work. This could be any stock market in the world, the UK FTSE, the Dow in the US, or any other global stock market. Companies are ranked in an easy to measure objective way by market cap, and that's the number of shares in issue times the price. At one end of the spectrum you have large companies, and at the other you have small companies. When you turn it on its side, you have a value company at one end. In other words, the price has a lot of potential movements in it and it could do really well. Or maybe perhaps it's already happened and you've got a growth stock. They are really the four defining elements of any stock market. To keep it simple, you have large, small, growth and value companies. If you look back at the developed world, remembering our data sets run back 60 odd years, large cap markets in the US and UK have done around 10% annualised. That's year in and year out through good and bad times, through all of the world economic crises that we've seen, and that's just how it is. If you look at small cap, the returns have been approximately 15% and value companies 14%. Now some people argue there's been no premium in value companies going back a few years, and they're right, but again, looking back over a much longer period, there has been. These things are cyclical and they ebb and flow naturally, and that's really how markets work, and that's what the returns have been. What we do is build portfolios in this north quarter here. We invest into the whole market, so we've got large cap, but we also focus our attention on small cap and then again on value cap. And that's how we really look at securing premium returns over main market indices for our clients. So what we end up with is the UK market plus small plus value. We end up with the global market alongside, and that's the whole global market itself plus small cap plus value. And then we repeat that again in the emerging world. So effectively that gives us 9 equity funds. We also add 1 global property fund, which takes us to 10 in total. That gives us exposure to the global listed property market too. And in my mind, that's better than going out and buying bricks and mortar, having to pay rental agents, stamp duty and legal fees. We can absorb, or rather secure is probably a better word, all of the returns from the global property market by just including our exposure within a fund. I'm not a massive fan of bonds, as I've mentioned in previous videos, but we've also got a combination of 5 bond funds. We use those to cushion the gyration of prices in equity markets. So that's our strategy, and we've found that it gets us predictable, consistent and solid results. In my next video, I will discuss the gyration of prices in equity markets and the investing behaviour that's necessary to have a successful experience.